The Federal Reserve just raised interest rates by 0.75%. How does this affect your wallet? What's going on, everyone? I am MetaMatt, and we're going to be talking about interest rates and how it affects your day-to-day life. The Federal Reserve is the central bank of the United States and is in charge of maintaining a stable economy. One way they achieve this is by increasing or decreasing the cost of borrowing money. When interest rates go down, it is easier for people to borrow money and in turn spend it. For example, lower mortgage rates typically mean more people buying houses. When interest rates go up, it's harder to borrow money, and because of that, consumers spend less. So like I said before, the Fed raised interest rates yesterday by 0.75%, which is a drastic move up. They also said that further hikes are coming, which could lead to less borrowing, which could lead to less spending, which in turn could raise the risk of another recession. So here are a few ways that this could affect you. So first of all, credit cards. Most people have them. Well, those have interest rates which are based on the Fed's rates. When the Fed raises interest rates, it becomes more expensive for banks to borrow money, so the banks then have to raise the interest rates on lines of credit or credit cards for consumers like me and you. So typically it takes 1 or 2 billing cycles for these hikes to start impacting day-to-day consumers like us. This might not impact people with low balances on their credit cards, but those with a lot of credit debt will start to notice the impact. However, with the Fed expecting to raise interest rates to around 3.5% by year's end, this could lead to high interest payments on balances for everyone. So now is the time to start focusing on lowering your credit card debt before the rates start to raise. Credit card rates are at 16.9% but are expected to be around 19% by the end of the year, which could be a new record. So that's credit cards. What about your current mortgage rate? Will that be affected? Or buying a new home? Well, that all depends on if you have a fixed mortgage rate or an adjustable rate mortgage. The most common is a 30-year fixed rate, meaning you have a specific interest rate for the entire term of the loan. Adjustable rate mortgages, as the name says, has adjustable interest rates based on the current economy. Fixed rates are more popular because they are easier to budget and less reactive to market conditions, and you lock yourself into an interest rate when you buy the house. But like I said, long-term mortgage rates are the more popular ones, and they are pegged to yields on government bonds, especially the 10-year Treasury Notes, which is at the highest it's been since 2011. So due to inflation, the average rate for a 30-year home mortgage has soared from 3.11% in late December to 6.28%. This means that homes will be more expensive for buyers due to the higher rates to borrow, therefore reducing the demand for home purchases, which in turn will cause sellers to reduce their price in order to attract buyers in these markets. Okay, that's houses. What about cars? Your current car loan is typically a fixed interest loan, so you don't have to worry about the interest hikes affecting you. However, for new buyers, the rates for people with lower credit will most likely rise. As for those students out there with student loans, all government-held student loans have been in a payment pause, with interest suspended, since March 2020 due to the COVID pandemic. This has been extended to September 1st. Any interest rate hikes will not affect your current loan. Those with private student loans will have to consult their borrowers. Lastly, how is this going to affect your savings account? Well, savings accounts typically don't benefit from Fed increases. The FDIC reported that the average savings account rate is a minuscule 0.07% for most banks. There are online lenders who have been competing to offer high savings with rates around 1%, and CD, meaning certificate of deposit rates, are upwards to 1.5%. With CDs, you do have to lock up your money for a certain amount of time or you will be penalized. So that all being said, if you put $10,000 into a savings account, you're looking at a return of $7 interest in a year, which is why I prefer long-term investing. Make sure to check out restandretire.com for that. I'll be breaking down all the different types of savings accounts and long-term investing options in a video next week. You can find me in our trading discords. The link to those are in the description of this video. I hope to see you there, but until next time, as always, I hope that you all make some bread.